Well, it was kind of disgustingly low. I didn't know what I was going to do. I had about $150,000.
Warren Buffett, 7 worst investments to make 2022. So far, Warren Buffett's top stocks for 2022. Should you buy them now? You need to keep up with Warren Buffett stocks because even though the Berkshire Hathaway CEO sticks to a winning investing formula, that doesn't mean he sits still. Hey folks, welcome back to Business Opportunities, where today we'll talk about the 7 worst investments to make in 2022 according to Warren Buffett. And let us dive in.
What happened was right at that period, the textile business was good for a very short period of time.
Warren Buffett makes investing appear simple. In 1941, when he was 11, Buffett bought his first shares of stock. By the time he was 15, he was worth about $6,000, which is around $64,000 in 2022 money. Over the next 70 years, the Oracle of Omaha used his skill at value investing to make a fortune worth about $100 billion. But Buffett doesn't fit the stereotype of a greedy Wall Street billionaire. In recent years, Buffett has given more money to charity than any other billionaire. He has given more than $46 billion to good causes. Even though Buffett has a huge amount of money, he still lives in the same house in Omaha, Nebraska that he bought for $31,500 in 1958. The best part for investors is that Buffett has been very open about how he invests over the years and has given his followers a list of things he looks for in stocks. Today, we'll share the 7 worst stocks to buy in 2022 if you want to invest like Warren Buffett. Number 1, Wells Fargo. For Warren Buffett and Berkshire Hathaway, this year signals the end of an era. The last of Berkshire's 675,054 shares in the money center bank Wells Fargo were sold off during the first quarter. Wells Fargo is no longer a continuous investment in Berkshire's portfolio for the first time since 1989. Although bank stocks are Buffett's preferred sector to invest in, Wells Fargo broke a fundamental guideline by betraying its consumers' confidence. Wells Fargo admitted in 2016 and 2017 that between 2009 and 2016, roughly 3.5 million fraudulent accounts were open at the branch level. This admission triggered a brief carousel among the company's management, eventually leading to a $3 billion settlement with U.S. regulators. Buffett decided to leave because it might be difficult for the company to regain its reputation. However, Wells Fargo has done admirably over the last 2 years. This is a bank with a long history of courting affluent customers. People with greater incomes are less likely to be rattled off their figurative roots by the economic recession, and this has assisted Wells Fargo in achieving some of the greatest returns on assets among money center banks. Number 2, Bristol Myers Squibb. Bristol Myers Squibb is a second well-known corporation that has been given the boot since the year began. Berkshire sold all 5,202,674 shares it owned at the end of 2021 during Q4. Berkshire Hathaway invested in a number of high-profile drug manufacturers more than a year ago, most likely to capitalize on all their COVID-19 research while also benefiting from their high dividends and generally consistent operating cash flow. Bristol Myers Squibb, on the other hand, was never a prominent contender in the COVID-19 therapy field. Worse, the blockbuster cancer medicine Revlimid has begun to see modest revenue erosion as a result of generic competition. These 2 criteria are my best guesses as for why Bristol Myers Squibb got fired. However, when viewed through a broader lens, Bristol Myers is a low-cost cash cow with the opportunity to grow. Eliquis, an oral anticoagulant developed in collaboration with Pfizer, has outsold Revlimid in full-year sales. And thanks to label expansion potential, cancer immunotherapy Opdivo has a real possibility to surpass $10 billion in yearly sales. Number 3, AbbVie. Bristol Myers Squibb isn't the only major pharmaceutical company that Warren Buffett's company has dropped this year. Berkshire Hathaway's initial purchase of AbbVie in 2020 has been totally sold. Buffett and his investment team sold all 3,033,561 shares they owned before the end of 2021. The reason for selling all of AbbVie stock was most likely the same as the motive for selling Bristol Myers Squibb. Although AbbVie gave investors security during difficult times, the company never became a major participant in the COVID-19 environment. Furthermore, its key product, the anti-inflammatory medication Humira, is facing biosimilar competition in overseas markets. While Humira sales in the United States increased by 2.2% in the most recent quarter, foreign sales fell by 22.6% from the previous year. Despite the fact that AbbVie remains cheap at 12 times Wall Street's anticipated earnings for 2023, Buffett's withdrawal in this case may make sense. In the first quarter, Humira accounted for 35% of global net revenue, and by biosimilar competition will eventually eat into its sales in the United States as well. Despite the fact that AbbVie purchased Allergen in 2020 to broaden its sales and product development pipeline, it's possible to imagine AbbVie's bottom line not suffering significantly in the next years as Humira sales decline. Number 4, Royalty Pharma. Keeping with the theme, Berkshire Hathaway's recent position in Royalty Pharma has been significantly reduced since the start of the year. A total of 7,151,896 shares were sold, leaving slightly under 1.5 million shares in Buffett's company's portfolio. Royalty Pharma, which earns royalties on the net sales of more than 35 authorized pharmaceuticals, was first added to Berkshire's portfolio in the third quarter of 2021. The fact that this stake was reduced by 82% between 6 and 9 months later suggests that it was made by one of Buffett's investing lieutenants, Todd Combs or Ted Weschler. Warren Buffett rarely holds a position for a few months. As for why Berkshire Hathaway sold 82% of its stake in Royalty Pharma, I believe it has to do with the anticipated exclusivity losses that are projected to hurt the company's royalty stream. Humira, for example, is one of the more than 35 treatments from which Royalty Pharma generates revenue. With a spate of Humira biosimilars slated to arrive in the United States next year, we may be witnessing the company's near-term royalty revenue peak. Number 5, Verizon Communications. What makes this transaction unusual is that Verizon was only a top 10 holding for Berkshire Hathaway for roughly a year. To summarize, Warren Buffett often invests in strong firms that he plans to own for a long time. It's strange to see Berkshire Hathaway jump in and out of equities in such a short period of time. If there is a driving force behind this massive sale, it could be historically high inflation. When the price of goods and services suddenly rises, the lowest centile of earners suffers the most. Despite the fact that cellular internet and smartphones have virtually become fundamental requirements over the last decade, inflation is limiting consumer spending power. The bright side of Verizon is that there are rarely any surprises. Wireless churn rates typically do not rise significantly during economic downturns, and Verizon shares are attractively de-risked at just 9 times Wall Street's anticipated earnings in 2022 and 23. Add a 5% dividend yield, and you have a boring but potentially profitable investment for conservative investors. Number 6, Kroger. In Q1, Warren Buffett cut Berkshire Hathaway's stake to one of his more recent favorite stock picks. The holding company reduced its investment in grocery operator Kroger by 3.4 million shares, or 5%. The move came after Berkshire reduced its investment by 350,000 shares, or less than 0.01% in Q4. Buffett first purchased the consumer staples investment in the fourth quarter of 2019 and aggressively increased his position over the next 2 years. Since October 1, 2019, shares have increased by 120% in total return, compared to a total return of 43% for the S&P 500. Kroger's year-to-date return was 27%, compared to the market's minus 4.6%. KR represents 0.8% of Berkshire's overall portfolio, down from 0.9% in 2021. Number 7, Store Capital. Berkshire reduced its stake in Store Capital by 39%, or 9.7 million shares in the first quarter. Store makes single-tenant investments in properties such as chain restaurants, supermarkets, drugstores, and other retail service and distribution operations. That is, Store is a gamble on physical retail, which is assumed to be in perpetual decline. Buffett, on the other hand, spotted value, and he spotted it for a long time. Buffett examined the REIT for 3 years before taking the position, according to Store Capital CEO Christopher Volk. Store stock had a difficult first quarter, shedding about 15% of its value while lagging the broader market by approximately 10%. At the conclusion of Q4, Store accounted for only 0.25% of Berkshire's equity portfolio. This has now been reduced to 0.12%. Any additional drop in the share price will have even less of an impact on returns. And that brings us to the end of this video. Feel free to let us know what you think about it. And if you liked the video, please leave a like and subscribe to our channel for more great things. Thanks for watching, and we'll see you in the next one.